Right now, across the UK, directors are being sued, family homes are being sold, savings are being wiped out, families torn apart, and it's all because of this one issue: overdrawn directors' loan accounts. Now, most directors, they rush into insolvency. They think every insolvency firm they speak to has their best interests at heart. They think it's a clean slate. They think that once they pay the £5,000, all the problems go away. And they don't consider an overdrawn director's loan. Now, they think it's just a technicality, but it's not. It is a personal liability that is going to follow you around like a bad smell, and if you do not handle it properly, it could destroy your financial future. Now, listen, this isn't just a theory. I have seen directors lose their homes. I've seen directors be made bankrupt. I've seen directors have mental breakdown, endure years of stress, all because they didn't take the time to deal with their director's loan account before liquidation. Now, listen, there is some good news, okay? It's not all doom and gloom here. You don't have to let that happen to you. In this video, I'm going to show you exactly what to do step by step to avoid those scenarios. So stick with me. I'm going to make sure you're armed with the facts that you need to protect your assets and your future, okay? For those that don't know, it's Chris Worden, Director First. I make these types of videos to help UK directors stay informed, and they're out every few days, so please turn on notifications, subscribe, give us a comment, let us know what you think. Right, I know what you're feeling right now. You're a UK director, you are stressed, overwhelmed, maybe a bit panicked, okay? Creditors are circling, your business is in trouble. And now you're being told that you might owe the company money too, okay? I know, because I've been there. I had to liquidate a business back in 2015. Worst time of my life, really, really frightening. Didn't know where to turn, and that's why I set up this company. Now, first of all, you're not alone, right? Across the UK, directors are getting blindsided by overdrawn directors' loan accounts every single day. I know, because they ring me. It is one of the most understood issues in the whole insolvency process, and it's one of the most damaging if you don't address it, okay? Now, the fact you're still watching this video shows me that you're doing something most directors don't do. You're here to get informed, and that is the first step to taking control of this situation, right? In the video, I'm going to cover exactly what a director's loan account is, how it works, how it turns into a disaster during liquidation, and I'm going to give you the exact steps that you need to take to resolve it before it resolves you. Now, it's not about keeping creditors at bay, this. It's like, once you go into liquidation, most of your creditors are written off. This is about protecting your family home, your peace of mind. So feel free to pause this video at any point, grab a pen, take notes. I want you to stay with me till the end, right? And if at any point you feel overwhelmed, remember, you do not have to do this alone. You can call us today for a free chat, 0800 086 2766, or you can actually book a free consultation using the link in the description below, okay? Right, let's talk about directors' loan accounts. And I'm going to break down every aspect of a DLA, why they matter, and how they affect liquidation, okay? I'm going to give you some examples, and I'm going to give you some engaging, actionable advice, okay? Right, let's understand what a director's loan account is and why it's so important during liquidation. So a director's loan account, or DLA, is essentially a running tally of the financial interactions between you, the director, and your company that don't fall under salary, okay, or legitimate business expenses. So think of it as a financial bridge. It records any money you lend or any money you borrow from the company. And what the DLA tracks, right, if we break this down, there's two sides of the equation. There's the credits, the money the company owes you, so any personal funds you put into the company. This could include for paying for expenses out of your own pocket, investing personal savings to cover a shortfall, and the other side is the debits. It's the money that you owe the company. Now, any cash withdrawals you've made for personal use, any expenses paid by the company that aren't strictly business related, and any advances you've taken in anticipation of future dividends. And that's an important point. People think the way they take money, they might take £1,000 a month and they take £3,000 a month in dividends. You can't take a dividend monthly, right? It doesn't work like that. You take a dividend at the end of the year when your accountant declares a dividend out of profits. What you're taking, let's say you're getting £4,000 a month, £1,000 via salary. The other £3,000 a month is anticipation of future dividends, okay? It's an important point. I'm going to tell you why in a bit, okay? Now you might be thinking and going, well, Chris, why does this matter, right? You know what? During normal trading, a director's loan, it's really just an internal accounting matter. When a company becomes insolvent, so you can't pay your debts when they fall due, liabilities are more than the assets, an overdrawn director's loan account becomes a serious liability for you, the director, and here is why. An overdrawn director's loan is treated as a debt that you owe the company. It's seen as an asset of the business, much like a building would be an asset, or some stock, or some plant and machinery. And once you go into liquidation, an insolvency practitioner is legally obligated to pursue the repayment of this debt on behalf of the creditors, okay? Now, if you ignore a DLA, it will lead to legal action, okay? You will be made personally liable. And if you're unable to repay the debt, the insolvency practitioner could make you bankrupt, okay? Super, super important. Now, most directors, they don't set out to have an overdrawn loan account. It happens gradually. Most people don't even realise it. Let's have a look at some common causes of why a DLA becomes overdrawn. Number one, personal withdrawers. A director withdraws money from the company to cover personal expenses. It might be for the mortgage, for the rent, for the kids, it's all legitimate stuff that needs to be paid. So let's say you take £2,000 here, £3,000 there, and your plan is to pay it back later down the line. But that stuff adds up. Another thing that trips people up is bad tax planning. Listen, I'm not a tax planner, right? I'm just a lad up in Preston that's advised people around insolvency. But some directors, on the advice of their accountants, what they'll do is they take a small amount of salary, and they top the rest up in anticipation that there's a dividends coming down the line. Now, that is a really good idea, right, if your business is making a profit, okay? That is the best way to get money out of your company if your business is making a profit. If we're assuming that at the end of the year, your business has sufficient profits to cover the money that you take out, right? The problem is if your business is not making money anymore, or it's making less money than it used to, the chances are that dividend you're taking every month, it's going to cause you to have an overdrawn director's loan account. So if you are doing this at the moment and you're watching me because you've got some business debt problems and that's how you're paying yourself, this should be grabbing your attention, right? Now, the reason why these overdrawn DLAs are a big problem in liquidation, it's because once you're in liquidation, that insolvency practitioner is legally bound to get that money off you so they can pay some back to companies' creditors. It is super, they're not going to write it off. Like many directors, they think that a DLA will be written off during liquidation. It's just another company debt. It's an absolute myth. It's a personal liability. And an IP, insolvency practitioner, is going to pursue you, in some cases, to the ends of the earth. I have that many cases I can share with you, right? But I'm going to tell you one about a couple of weeks ago. A guy's rang me and I've got his number in my phone. Let's call him John Job, right? Okay. And I'm thinking, I wonder who John Job is. And I've answered the phone and he spoke to me 3 years ago. And the reason that he didn't go with me is we were too expensive. Because I had rightly pointed out to John that he had an overdrawn director's loan account. And it wasn't just £4,000 to go into liquidation. We're going to have to do a deal and he's going to have to pay some of that out. Some of that director's loan account back. Well, John ignored me and he went with a firm, a really big firm. And 3 years later, they're on the verge of making John personally bankrupt. And you know, the reality is I said, John, I can't help you. And here's the truth, is I'm that busy at the moment. If I give you advice and you don't take it and it causes you a problem, I can't help you down the line. I literally can't. You've made your bed, you're going to have to lie in it. As tough as that sounds, right? This situation could have been avoided with the director understanding this issue. Now, the way that you solve these problems, and I say solve, it's not that they can be written off and sort of, you know, buried under the carpet. But if you've got a director's loan account, right, your insolvency professional should be asking you about that. So I'll tell you what I do here. You give me a call. And I'll go, right, send me a balance sheet of your business, an up-to-date one. And on there, it will tell me if you have a director's loan account, okay? Now, some people don't have balance sheets. So I'll go, right, or up-to-date ones. I'll say, send me your last set of accounts. And it will tell me whether you have an overdrawn director's loan account. And let's say your accounts are a year out of date. I'm going to go, right, listen, what have you got to protect here? Okay, what is it you need to... Have you got a big family home? Have you got equity in your house? Have you got buy-to-lets? Have you got cash savings? Because I need to understand what's going to go wrong for you. If you've not got a pot to you-know-what in or a window to throw it out of and you're on universal credit, this isn't that much of a problem. It'll get written off. But if you've got stuff to lose, this is really serious because it's at stake. An insolvency practitioner has powers to recover your personal assets in respect to directors' loan accounts. So I will say to you, right, we either need to get those accounts brought up to date to today so we can understand the final position, or let's do a bank analysis. Send me all your drawings out of the business. Let's work out what you've taken out of the business since your last set of accounts. Let's see what expenses you can have, and we start to understand what your final position is. Because before you liquidate, you want to find an insolvency practitioner who's willing to have this conversation with you. Because a lot of them will say, don't worry about it, we'll have a conversation down the line. That comment should make the hairs on the back of your neck stand up. And you need to say, no, I don't want to have a conversation down the line. I want to have a conversation right here and right now. Because an insolvency practitioner has the discretion to offer discounts on directors' loan accounts. Okay? Some of them don't want to, at this stage, have that conversation. And the skeptic in me says the reason they don't want to have this conversation is that they want you to appoint them for $4 or $5 And once you're appointed that insolvency practitioner, there's no going back. There is no going back. And they can chase you for the not till the end of time, but for years and years to try and get more money out of you. And why are they chasing you for years and years? Because they can bill fees for years and years. Where those that are informed, if you're one of my clients, what we do is we find out the problem and we go to one of the IPs and we go, right, this is the situation. John has got a director's loan account of 50 grand. He has a house with 60 grand equity in. He has 25 grand's worth of personal debt. He has a self-assessment bill that's unpaid. And we start to put together your personal position. And on the back of that, we can get a deal done. We can get a discount done where you pay a proportion of your director's loan account. Most of it gets written off by the insolvency practitioner and you pay it over a period of time. Now, I'm not calling an insolvency practitioner out for aggressively pursuing a director's loan account. That's not what I'm doing. Because an insolvency practitioner, that's their job. Most of you guys don't know what an insolvency practitioner is there to do. You think they're there to help you. Okay, there's some really good ones, but ultimately they are there to represent the creditor's interests in an insolvency, not the director. And a director's loan account it's like a tangible asset. So they're trying to recover that money from the director so they can pay a dividend back to creditors. They're just doing their job. What irritates me a little bit is on day one, I know whether you've got a director's loan account, or I might have a sneaky suspicion with a little type on Company's House. By having a look on Company's House for 10 seconds, I've got an inkling whether you've got a director's loan account, and so do they. So the key thing here is, like anything, you've got to have an open and honest conversation. I'll tell you a horror story that I was involved in. There was a guy at COVID time, and he just didn't tell the truth, this guy. And I said, listen, I am the guy that you tell everything to. I think he hadn't done his accounts for a couple of years. He ignored my advice to get them done, wouldn't give me any bank statements, but he had to go into liquidation because he had some pending legal action. This guy went into liquidation. We did him a deal on his liquidation fees to help him, and he just went to ground. He just disappeared. Anyway, the insolvency practitioner had to do what they had to do. He didn't comply, didn't respond to anything. It turned out that he owed hundreds of thousands of pounds, but worse still, he was a really wealthy guy. It ended up costing him 150 grand. Now, that's a horror story. You know, I've had directors that have got directors' loan accounts of 50 grand, but they don't have anything. They don't have any assets. They've got no hope of realisation. And then a good insolvency practitioner will go, well, there's no point me chasing that. I'll write it off and I'll close it down. You know, you can get deals done with insolvency practitioners, but the key is you've got to act earlier. You can't wait till the insolvency practitioner is appointed to do a deal on a director's loan account. Trust me. And if somebody you're talking to about insolvency and that you're asking for what it's going to cost, you need to ask them, listen, I've got a director's loan account. You can find out where your director's loan account is, either on a balance sheet, on your accounting software, or in the assets section of your accounts. And if you've got one, or you think you might have one, or you think you don't have one, you want someone to check it. And that's what we do at Director First. We can't sweep anything under the carpet, but we go through this bit by bit, so nothing is going to come out and bite you on the arse that you don't know about. So please call us 0800 086 2766 or book a free consultation in the comments section below. Okay, we've helped thousands of directors over the years keep the homes and get an affordable repayment on their directors' loan accounts. Do not leave anything to chance. Be transparent, provide a full picture of the situation, and everything that you say, you've got to remember that you've got to evidence it. You can't tell us you've got loads of personal credit card debt when you haven't. You can't tell us that your house is not worth what it's really worth, because we're going to have to get a valuation. We can't say that your mortgage is more than it really is, because we're going to need to see a redemption statement. But I promise you, this is where we set ourselves apart from everyone else out there on the market. We are the most trusted and relied upon insolvency firm on Trustpilot. Get in touch with us today. Chris Worden, Director First. Thank you.